classic quote is, you're only as good as your last trade. To start from zero every January 1. Obviously, if you go to one of the top 5 Ivy Leagues, you could be recruited right into the buy side or a top hedge fund. I wasn't in that camp, so there's a lot of ways to get there. But at the end of the day, the most important thing is grit and curiosity over pedigree.
My guest this week has seen the highest levels of finance from 2 titans of the hedge fund industry. This is Doug Garber, the CIO and managing partner at Westport Alpha Group. Formerly, he was an analyst at Citadel and a senior portfolio manager at Millennium.
Citadel, I was there a lot longer. They've learned a lot of things over the years, and there's a lot more structure. Whereas Millennium is less homogenous. There's a lot of different strategies.
What traits have you seen where you can really tell, okay, this guy's going to be a great analyst?
The great traits are...
Doug, thanks so much for doing this.
My pleasure to be here. Thanks for inviting me.
Of course. What makes a great fundamental investment process?
A great investment process is domain knowledge. You need to have a deep knowledge of the companies and the industries that you're investing in. You need to understand the businesses, how the businesses operate, so that you could understand what are the drivers of the business, when there's a variant view, and when the industry is changing, or when management might be overplaying their hand or underplaying it. So it starts with just a deep understanding of the underlying business before you start to get into what the stock is worth.
100%. It makes a lot of sense. Your background's very unique in that you went from the sell side before you joined these large multi-managers, namely Citadel and Millennium. And one of the things that I find very interesting about being at these shops, or at least from what I hear about being at these shops and running a pod, in your case, is I feel like the mind, the way your mind is wired to run a pod is very different from just simply picking it, buying and holding companies. I feel like you have to think about your exposures, think a lot about outperformance. But one of the things, the main thing you mentioned when I asked the question, what makes a great fundamental investment process, is understanding the company, understanding the industries, and understanding those things very, very deeply. And so I'd love to hear it from you.
Well,
go on.
I would say the common theme is research. And if you ever talk to Ken Griffin, or if you've heard him on these recent podcasts, he says, Citadel's a research shop first and foremost. Trading is just how we implement it. I spent 10 years doing sell-side research in the domain. So then going over, using that base knowledge, then when you move over to Citadel, I used then, how do I shape that knowledge? You're 90% of the way there into a bet, into a variant view. And that's what my first PM taught me. And he came from SAC at the time, or Point72. And he's like, all right, now let's place a bet. You have all this great knowledge. My edge is you, because you've been studying this industry for so long. And I actually, learning on the sell side, it's great because you're learning the knowledge that you're going to need. And it's the same knowledge you'll need on the buy side. You're doing quarters, the management team, and it's actually pretty common. A lot of the people that I ended up working with came from the sell side. And what happened is the long short businesses keep getting bigger, and we're so big, they've picked out all of the sell side juniors that have been there. It's kind of like you work on the sell side for 2-3 years, you get picked up, and now they're starting to recruit out of colleges. And, Point72 used to go right from banking. So that skill set of the deep research is very transferable into the buy side from the sell side. And then the other place people go is obviously, people put in their banking. You do investment banking for a couple of years. You learn some model. You're kind of, what we would call a good athlete. So they pick up those people and mold them a little bit. And now they train them, right out of school. So they're like, so you have fewer bad habits. And the more time you could be trained by other teams and other mentors and being around that, you'll learn from. It's a lot of lessons that are passed down in the hallways, at the water cooler, and lunch, because a lot of it is applicable, even though you have deep domain knowledge, and I couldn't go trade a healthcare stock, but some of the things that the setups, the way positioning is, there are certain things that are common across all of them that it's actually, you share with them, even though the guy next to you is doing, maybe healthcare or another sector that I knew absolutely nothing about, but it's sort of the same game.
And so do you think that, maybe you're biased, but do you think that the sell side is the best place to learn before entering one of these long, short shops? I'd love to hear your thoughts.
Well, I am biased because I started there. And I think that's the best for me. So yes, I'm biased. That's important to know. Obviously if you go to one of the top, 5 Ivy Leagues or whatever, you could be recruited right into the buy side or a top hedge fund. I wasn't in that camp. So there's a lot of ways to get there, but at the end of the day, the most important thing is grit and curiosity over kind of pedigree. I know, there still is some pedigree, especially in the long only space. And now even some of the top hedge funds, they're like, well, we want the grit, the curiosity, and the pedigree. We want it all. And the top people can do that, but there's a lot of ways to prove yourself and to get the knowledge. I think one of the funny quotes was like in one of the MBA programs, there was one of the professors said, well, if you were good, you wouldn't be here in the MBA. You would have already figured it out at, 22, 23, you'd be trading yourself. You would have had a passion for it and, you would have found it. Right. I mean, there's the stories about, Steve Cohen watching the ticker tape in the rain outside of the brokerage houses, right? That's what he loved to do. So if you have the passion and the curiosity, there's a lot of ways to get to the buy side. And that's what they're looking for, is the unique people. The drive, I think, is the most important.
No, for sure. I guess that life lesson applies to everything, to anything. And one of the things I am very curious about these large shops is the way they. So you take a shop like Millennium, the pod structure, separating people, separating all these exceptional people. Do you think that? I know that their philosophy is that you're able to get everyone thinks somewhat independently, and you can risk manage on top of that. And I'm curious about that. Do you think that sort of structure, competition maybe between the pods, do you think that makes these exceptional people that you're talking about, people with drive, do you think that puts them in an environment where they can truly thrive and generate exceptional ideas? I'd love to hear it from your perspective, having worked there.
Well, 2 different places, 2 different cultures. When I was at Millennium and I was at Citadel, and they're somewhat different, even though they're from the outside, they're both top hedge funds and pod shops with multi-strats. Millennium, they're decentralized. They want each team to be independent, and they want uncorrelated returns. They want your P&L or alpha stream to be uncorrelated from what they already have. Right? They'd probably rather take a second team in a sector, not necessarily based on the highest P&L, but if it's uncorrelated and it's additive to their overall, right? Because they're trying to produce P&L every month, and that reduces their overall risk by having uncorrelated streams. And there's not a lot of sharing of information. Your pod is essentially isolated. I mean, obviously you're in the same building, you have the same, LPs, and you share meetings at conferences. But it's your team, it's your business. It's kind of, they're just your investor, right? Millennium is essentially a fund of funds and bringing in top talent and seeding them. And they're just trying to get different strategies that are uncorrelated with great people. And they want you to be entrepreneurial and do what you've been doing. So they're not taking risk of, oh, you're a good athlete, let's go have you do a different sport. They want you to do the same exact thing you were doing, but then grow the business how you want to grow it, So they're very much like, as a PM, you run your own business there, and they're giving you all the back end support, all the capital. You're in charge of hiring. I mean, they give you some support and some help there, but recruiting and hiring is the most important thing. And then, on the trading side, they obviously have world-class systems to help you from there, so you can focus on idea generation and portfolio construction and, mentoring your team and risk management. So it's a little bit of a philosophy there where, I don't know how many equity teams there are. There might be like 200 or something. And, they have different strategies. You don't necessarily even know people that are in stat arb or commodities or macro. Those are different, right? Now at Citadel, so also at Millennium, you don't necessarily know how the other teams are doing. There's no way for me to know. I get the same information everyone else does about how the fund's doing from Bloomberg. I mean, I'm sure if I ask management, they'll tell me it's not really that relevant. The fund is so big and robust. There's not really netting risk at the PM level. It's a great thing to have that. Citadel is structured a little differently. They have currently 3 equity platforms, or maybe a 4th internationally. So it's obviously global equities, Surveyor, which is where I work, Ashler, and then there's another international division. So now within each one of those, there's kind of a separate business head, and those are run individually. Now there's also macro and energy and other strategies there, but there's a little bit more camaraderie between when you're in one of those divisions. You're more friendly with the people you're sharing meetings in those the few other sectors and the people, just because it's kind of like a little group. You're sharing all the meetings. If you're at a conference at Millennium, it'll be 10 different people with half of them with different names, a couple with the Millennium name, all sharing a meeting. If you're a different thing, if you're paying the street together, that's what happens. At Citadel, it's kind of broken into 3 different groups right now. And and you also share information. You might share notes. You might talk to them in the hall. You're on the same floor. So there's a little bit more communication within and that depends. That's up to your PM. Your PM is like, nope, we're not talking to anyone. Our ideas, that's it. And it just depends on the culture also of that, whoever's running that division. They might say, let's be collaborative. You might want your tech guy talking to your energy guy or talking to your industrial guy, your consumer guy. They might want that culture, and that's up to the head of that division. But I found it to be a little bit more collaborative within there. Now there's only probably 20, 30 teams per division, roughly. And there it is much more competitive. You know how people are doing on a daily basis, and it's the same as in baseball, where you see the stand-ins, and the thought is these are competitive people. They want to see it. They want to do better. So let's when you have competitive people, they want to win. So you might as well show them where they are on the standings, and that's going to motivate them. And it works, right? It's just the sort of people you screen for. And there are analogies, to sports, baseball, football, throughout the culture. It's the same sort of thing where you want who's on the field, or your starter, do you want to win? And yeah.
Which culture did you prefer? I mean, we're having worked at both places. Which one did you enjoy more?
Well, they're both phenomenal places to work. And you're lucky to be in either one. They've both got an outstanding reputation. They got everything you need, from capital to trade-in to some help hiring. Citadel, I was trained there. I was there a lot longer. They're much more, they've learned a lot of things over the years, and those things are passed down, and there's a lot more tools and processes and, tighter risk controls. And there's a lot more structure, right? There's a lot more guardrails and structure, and we've learned what works, and this is what we want to do. And it's a little bit more of a unique system that you kind of have to be brought up in, right? Whereas Millennium is less homogenous. There's a lot of different strategies there. I mean, Citadel has different strategies too, but at Millennium, it's more, here's your capital, good luck. And you have your strategy, your processes that you implement, that you came with, that that you understand. And for me, that was the things that I learned at, over my time on the sales side and at Citadel. And your processes and those things, you're always improving them, right? You have a process, you're learning, you're doing postmortems, your feedback, and you're always trying to improve and learn from your mistakes. So I think Millennium, they're a little bit more entrepreneurial. Like you can kind of go in your own direction. Obviously there's management you're talking to, and you've kind of already agreed on what box and what are the parameters. But they're both phenomenal places. It's just, what are you used to? And I would say there's probably a few more rules or more particular things that kind of know what work. At Citadel and Millennium, we trust that you know what works and go for it. And it's your business, you go grow it, and you're the entrepreneur. Whereas Citadel, it's more, this is what works. And you're brought up in that.
No, fascinating.
And this is in the equities,
Yeah.
right? A lot of different people are going to have different experiences based on who their PM is, who their sector head is. So you could have different people having very different experiences at different shops. And the truth is, the people go back and forth. And when I started at Millennium, you go for all the hires and rehires. And actually, when I left Millennium, Citadel was trying to get me to come back. So you always want to be friendly to both places. I mean, it also kind of just depends what they're looking for to given what positions are open, what teams they're trying to build. And what the timing of that. Citadel's more about, they want to build robust teams, right? They want to, and that they're going to know the analyst, they're going to know the PM, the associate, the senior associate. Whereas at Millennium, they have a relationship with the PM, and then the PM's in charge of. There's not as much monitoring. I mean, there's some. They've definitely implemented things over the years, but they're buying their businesses with the PM. Whereas there might be multiple at Citadel. There might be relationships, and that's true at both places. Yes.
Yeah, I was listening to a podcast. I think it was Giuseppe Paleologo, and he was talking about the differences between the shops. And I like the metaphor he used. He likened Citadel more to more like a Singapore, something centralized, something that's run very efficiently, but a lot of government intervention. And then he likened Millennium to like the U.S. I mean, you have all these different states, all with their own rules and regulations, but both systems work, and both work in delivering growth and prosperity. I guess one of the things I want to transition more towards, I just want to talk a little bit more about, is the way risk is managed at these top multi-managers. And I think we were talking a little bit about this, before the call, before we started the podcast. But I guess I'd love to hear it from you. What are the ways that risk is managed for these two respective titans? What was it like?
Risk, there's definitely a quantitative focus in terms of what I would call a quant overlay. I mean, fundamentally, you are investing, you're doing your work, but then you want to also, if you add up all these stocks that you have in your portfolio, these 80, 100 stocks, you might have, your biggest position might be, 5-6% on a GMV basis. But if all these positions have a 1%, factor exposure, you want to be aware of that. You don't want to have a 15% bet on a factor that you're not even trying to make a bet on. So you want to be aware of that. So you want to have the quant overlay there. And, you grow up in the school model, there's a lot of focus on the risk models and what are the factors. And, you're typically held to, it's pretty well known in the industry, you're typically held to an IDEO, which is the amount of risk that you're allowed to take that is not alpha, right? You're trying to target the alpha, which is the residual, what's left over after the factors. Obviously, you're not going to run 100% IDEO, which means everything is alpha. So you're going to have some exposure to these factors, but they want the majority of what you're doing, 85% of what you're doing, to be focused on the alpha. But, if you have 15% or so risk and the target, the bottom number, it changes. What, maybe it's 80, maybe it's 83, maybe it's 10, because the model changes, right? The model will change based on which factors you're putting in. And so it's not a simple number, and you are held to a number. But there's also ways to hedge that. You could also put in quantitative factors and limit factors that all they do is hedge your risk to do that. But you have ways to look at your stocks to know. I mean, my second PM at Citadel, I think his job every day was to come and say, how do I get my IDEO higher? He wasn't looking for how do I size up a name. He ran the highest IDEO there. He was, really good at managing risk. And that was from an earlier experience that he had, like early in his job career, he went to the buy side, and the PM blew up on like a super concentrated, like dry bulk trade in like 2 months. He had to go back to his wife and be like, oh man, go back to the sell side. And then he came back. So super risk adverse, and he ran the highest IDEO, but that was his job as the PM. Like a PM, you could be a great recruiter, you could be a great stock picker, you could be a great risk manager. It's a different job than being an analyst. And he would, literally, like they would tell you, right, it might be your highest conviction idea, but if you trim this or add to this, it'll help your IDEO the most. So they had a lot of great tools to do that. So you are looking at your IDEO on a daily basis to try to know where it is, because you're held accountable to maintain a certain level. Now you got to balance that with your analyst convictions and catalysts and, price targets and all that. So there's definitely a quant overlay there. And the more senior you get, when you start running capital, you start to be aware of it. And then when you start, a lot of analysts, they run money, and then you get to be a PM, you're aware of not only your risk, everyone else's risk, the combined risk. So, when I was there, I would look at 4 different risks. I had, the risk of all of the energy and industrial book, the risk of my energy and industrial book, and then the risk of like the combined, because there's a center book on top of it, energy and industrial, that I ended up running. And so I was running 4 different books there, and you can look at any different combination of the risk. So, and the risk is essentially just what is your what is your IDEO? How much of your bet is alpha, which is what you're focused on, and the higher the better, right? If you could be 90% alpha, 10% factors that we have no skill in betting on. I'm not in the business of making a trade on short-term Mo, long-term Mo, value, short interest. Quants do that. That's not my skill set. So I want to focus on the fundamental stuff, the stuff that quants can't explain. And then, you go to Millennium, there's like, you define where you expect to operate in terms of the risk parameters. And this goes from everything from, market risk to obviously there's currency risk. There's then the quantitative factor called style risk that we were just talking about. And then there's industry risk. And there's a little bit of a debate about industry risk and if that's a skill or not. And, do analysts have that skill set, or is that considered something they can't forecast? And then we get into the GICS code, and you can start debating about, why is this classified like this? It shouldn't be classified like this. So you can get into debates with kind of the risk team on that, because it might be throwing off your risk metrics. Other times people had overrides in the risk model from to other sectors. There's one risk model. So you got to it's making you aware of what bets are in your book. You obviously know that you like this name and you have a 5% position or 3% position because you like it this much. You expect this to happen. But you want to be aware of these other bets in the market that are in your book that you're not trying to make a bet on. Or other exposures. Do you have currency exposure? Are you trading in Europe or Canada? Do you have sector exposure that you don't actually want? Because there's other people trading those bets that can impact you. that you want to be aware of. And at Millennium, there's not like a strict IDEO floor. And again, the risk models are different. I don't think people realize when you start talking about IDEO that it depends which factors you put in there. And then the models can get updated. Are you doing a sector model? Are you doing a full US model? Are you running a European model? I would try and run, market neutral. I wasn't taking, could easily hedge out the beta, the SPX. That's an easy one. Currency, I trade a little bit in other markets. A little Canada, a little Europe, but I wasn't taking a lot of currency risk. Industry bet, Millennium, it's more they're just kind of looking at the stats. Now in the last few years, they are starting to dig in. They have another layer of management to dig into all the teams and understand what's going on behind the P&L. So they're getting more similar. They're adding a lot of the same functions. They're both great places, right? It's just slightly different. There's some people who say, well, there are others in the industry who would say, if Citadel's great for an analyst, Millennium's great for a PM, but I think it's all situational and timing. I mean, I think the most important thing is hiring. And also when you move, you have a lot of goodwill you're leaving behind. You don't get to keep that goodwill of your previous track record. You're starting from zero. Although I think, the classic quote is, you're only as good as your last trade. You're starting from zero every January 1. We used to kind of say this every quarter, like, all right, the scoreboard's 0. Like, doesn't matter if you're up on the year or down on the year, the score is 0 going into the quarter. Let's try and make a few percent on gross every quarter. And that was the strategy.
When more traditional people who came from funds that didn't look at IDEO, it was kind of just select your names and then buy and hold them, let's say long only. When those types of PMs would get recruited by Millennium and Citadel, how would they deal with having to think in IDEO terms all the time? Because I imagine it's a bit difficult to explain to someone, let's say he's very much long NVIDIA, well, NVIDIA was shooting up, but the risk managers are like, make it such that the bet is only on the IDEO of NVIDIA and not on the momentum factor, for example, or tech, or how did these firms train their managers to be able to think in those terms?
So, two different firms, right? At Citadel, you're held to an IDEO. You happen to run that way, and there's definitely great people who have come in and you're changing their style and their risk parameters, and it's just harder to make it work, even though they're super talented. I grew up in that system, so you're not gonna. It's a risk when you bring in outside talent, and they obviously have internal talent and outside talent. I'm not sure how many long only PMs they've brought in. It tends to be more long short. If they're great people, I'm sure they have brought in long onlys and tried to train them. That's the sector, the head of the division or the QR team, they're going to work with them. But it's a process, and they're probably going to be frustrated. My first PM came from SAC or 0.72 and then came in and he ran the lowest IDEO. He hated the thing. We were trying never to open it. He was just trying to run money, and he was always at the bottom getting reminders and ran high volumes. And I don't care about this. I'm just going to run stocks. And that was between him and the head of the division. So yeah, he was always frustrated. He didn't embrace it because he came from the outside. And, I think everyone at this point, not everyone, but a lot of the other shops, you really have to be factor aware. I think you don't necessarily have to be held to it and make trades just to appease the factor model. I mean, there are times where you will, when you're held to it, right? But you don't, even the other shops now across multi-strat, you really have to be factor aware at a minimum. And, I haven't been at BAM or P7, but I'm pretty sure it's embedded in the culture at this point as well. And they've also at one point P7 was going, they were more risk takers going for bigger bets. And then they've kind of said, oh, we want less vol, more, tighter constraints. So I think they've kind of conformed to, I would call it the Citadel of kind of lower volatility is what the industry has kind of wanted. So it can be tricky. At Millennium, when they hire people, they have their constraints, but they're not holding you to a risk model, but they want you to do exactly what you were doing before. So they're not saying, hey, you were doing X. We're going to come in and have you do that, but we're going to put a different wrapper on you. You're doing the same thing. We're trying to empower you. So, you've also seen people, Citadel try to start hiring earlier on and train people so you grow up in that system. It's one less risk, and it's something I'm sure they weigh when they are hiring from the outside versus promoting from the inside. And they like to do both, it's organic and inorganic growth, like any sort of business. But there's less risk when you promote from within than hire externally because you don't know. It's more of a unique operating environment, and trying to change a talented person has a risk that can be fine if they're super talented and committed, or might not work. It's just
in your experience hiring as a portfolio manager, what has made the difference, or what traits have you seen that where you can really tell, okay, this guy's going to be a great analyst? What are those traits?
So the great traits are drive. You have to be committed to go above and beyond and hustle. You have to be curious and a self-starter to go figure out what you need to go learn and go get that information. And you have to be willing to learn. You have to know what you don't know, which is always humbling because there's always more we don't know. And then you want to have an even keel, because when you get one right, you feel great. When you get one wrong, you feel not great. And you want to make a logical, rational decision and be able to look at the evidence and not make an emotional decision. You want to say, did this move for a reason? What's the evidence? And that gets hard when you're managing the risk and you have real P&L. And I think the quote was, Joel Greenblatt said, they're renting my stomach. That's what it is. And you don't know, they could be the brightest person in the world, but once they're managing risk, how are they going to react? Right? Are they going to have something go against them and say, oh, I lost money, I'm out? Or are they going to say, well, it went against me, but for the wrong reason, my thesis is still there and we should buy more. So that you have to kind of do the work in advance and have your signposts and your evidence. This is why it's important to do the work. You just get a tip from someone, you're going to have a position, but you're not going to know when to double down, when to exit. So it's always important to kind of have your thesis and write the signposts out ahead of time. And then I think the other thing is you need to have an attitude of your only job is to make your boss's life easier, because they have a lot more weight on their shoulder. They're managing the risk. They have a lot more positions and a lot more on their shoulders. So you have to have that mentality that and the best way to do that is to give them good ideas with logic behind it, and that they can trust that you've done all the work and haven't taken shortcuts. So it's, it's about process, and accountability. And, there's this big debate when you hire people. Do you hire for domain knowledge, which is what I had and what I typically started with? Or do you hire someone who's a great athlete, might take longer to ramp, but can continue to grow with the business or can adapt? And, when I started with, domain knowledge, because you also have to, there's a little bit of pressure when you launch to get up and going relatively quickly. Now, I think I've been on 4 different teams, and one team I inherited a book and we grew it. And the other three, we started and starting from zero. So you do a bunch of launches, you can be on a few different teams. So it's domain knowledge or the athlete. And some of the people who had a lot longer careers, they hired people that were more junior, more moldable. They were with them longer too. You hire a more senior person, then they're just people are always moving around. Retention, it's a tricky thing in this business. So that's always the debate, athlete or domain knowledge. And I don't know that there's a right answer. I definitely have noticed a couple examples, call it N1, 2, and 3, where perhaps going with the athlete who will learn is the better long-term decision. But you also have me telling you that domain knowledge was my edge, that I knew the industry, I knew the companies. And that's just pattern recognition, and understanding through cycles, what's next. And I think the other important thing is just, you have to know the industries and the companies really well. We always give companies the benefit of the doubt that they know more because they're on the inside. And they are on the inside. We're in the cheap seats as analysts. But there are times when, they're always going to forecast a rosy situation. That's probably why they're the CEO or whatever. We could kind of see clouds on the horizon, or we can be a little bit more intellectually honest. And, when you have that variant view where you're seeing something that the management's not, or you see something that's likely going to happen, that's when you kind of know you have a good variant view.
If you're an analyst and you're not happy with the decisions your PM's making, knowing fully well that your job is not to tell your PM what to do, what should one do in those situations?
Yeah, the analyst PM relationship communication is super important, and you got to develop trust and credibility with your PM, because PMs have a lot on their plate and they're essentially starved for new ideas, right? Your newest ideas, quasi your best idea is kind of the saying, and there's a lot of turnover, and they need to be able to trust you. So if you make a mistake, you gotta say, hey, I'm wrong, let's move on, here's why. And there's always this kind of training, or not this friction, right? Where the PMs it also depends. Are you trading the sector the PM knows the best, or are you trading the sector the PM doesn't know and they're relying on it? How senior are you? But I've always found that there's always this trick where the analyst has a recommendation, or they're saying this and the PM doesn't listen, and the analyst is right. And then usually you need kind of one of those to happen before the PM's like, all right, I'm just going to listen to you, carte blanche. But it kind of takes 6 months of you proving, hey, I've done the work, I'm in the model. They ask you questions, the numbers off the top of your head. I just spoke to management. You got to at least prove credibility on the numbers. That's your job, is to get the model and the numbers right. The setup's a little trickier. PM's going to want to have a say on that. The sizing, that's going to be something you do together. If you both love it, how much room do you have in the book for your high conviction idea? Or remind me before earnings or before the catalyst, or you're starting to talk about an idea, the PM likes it, he starts to put in, you're like, well, I wasn't done with my work yet, but you kind of liked it and he's buying it a little early. So you got to communicate every day. The communication, when I started, my boss he wrote communication in all caps. It's the most important thing. So it's your job as the analyst to communicate what you want to do and why. And it's like, oh, I told my PM this. No, you told him once in IM, no. You told him in your weekly, you told him in your IN, you called him twice a day, you kept showing him more evidence, and you should be evidence-based. In the beginning, no one cares about your opinion. They care about your evidence. So gather the evidence, put it into the process, and then after a while, people will ultimately care about your opinion, but support it. Show the evidence of why you believe that, or what you uncovered from, whether it was a management call, an expert network call, customer call, whatever, however you're building your mosaic, and why you believe what you believe. If you show your PM your evidence, and you need to kind of do it over and over again. They have so many small pieces coming in and out. You can be like, oh, I told you to buy that. I sent you an IM a week ago, you didn't buy it. No. Every morning you tell them what the new news is, what it means. It's not always going to be good for your thesis or bad, but you're collecting evidence and you're organizing it to make their life easier. So they know that the 30 names that you're responsible for in the book, that you know everything there's possible to know out there. That's how you gain the trust, that they're not learning something new from, they're reading a sell side note and they're learning something new and they're like, how come they're learning this before you? You need to be on it, because sell siders are spending a lot of their time marketing. Your only job is to do research, and you have every resource available to you. And you got to wake up and think about, how do I go down this rabbit hole and dig into this customer relationship or this contract or this dynamic to figure out what the debate is and how do I have a view on it. Just showing the evidence is important, and to get the credibility. And saying when you don't know, it's different, because when you're on the sell side, you're supposed to have conviction whether you know or not, right? Not a lot of people will, and then I'll have to unlearn that, because you need to say I don't know, but I'm going to spend, that's my number one priority. I'm going to get on the expert calls. I'm going to go fly to management next week, whatever. I update my model. I've done these scenarios, I've read the K, I know whatever it is, that's all table stakes, right? So you just got to prove that you've checked every box and turned over every rock, that you're not going to be right all the time. That's the hard thing, right? I think Griffin was saying, an analyst, his best people have a 54% hit rate. That means you're wrong a lot, and you still got to get up and go again. So it's about resilience, right? So yes, it's being intellectually honest, and you got to click with your PM. And they're stressed, they're yelling. I mean, it's different personalities. Sometimes they'll chew you out. That was never really my personality, but you just gotta, I've seen it, I've heard it. I'm like, wow, that's a lot of yelling. Sometimes it works, right? People, they know no one's gonna yell at, so you're gonna make sure you get your numbers right, and right. So I've noticed it works sometimes. I wish I had that in me to kind of yell at people and chew them out. It's not my style. So yeah.
Oh, the thing you mentioned of yelling, I find that very interesting. Because, I mean, this is on a personal note, but I had this realization for talking to my mom before leaving for my master's, that when my parents would get angry at me, they wouldn't always actually feel angry. They just needed to correct certain behaviors. And I imagine that it might even be similar for a case like this, where maybe, someone's running a pod and one of his analysts messes up big time. If he yells at him, maybe he doesn't actually feel the emotion, but perhaps he's just trying to get the memo sent over to the analyst that this is not how you should behave. This is not what you should be doing. You shouldn't make these errors. And I found that extremely interesting. Now, I guess related to that, that intellectual laziness in that situation, right now, go on.
There are a lot of situations. I mean, you're going to be wrong. Even if you've done all the work, you don't know what's going to happen. You're wrong. You can still be wrong.
Mm-hmm.
You don't know what the numbers are or what management's going to say or what the stock's going to do, even if you knew that. So sometimes it's just the way the PM's venting. You just have to yell and get it out. And they're not yelling at you. They're just mad at this, so don't take it personally and just let it vent, and then say, all right, here's our evidence. Come grounded. Here's our evidence. This is what we learned. This is what we're doing. And I had one PM who he wasn't yelling at me. He was just yelling to get it out of his system, because he was mad that this went against us, and we're still we're still a team. You're still the advisor. All right, now what do you want to do? So I found that he was yelling more at the frustration, not necessarily at me. But I've worked for great people. I was lucky. But when I just started at one of these places, around the corner, I'm like, I heard all this yelling. I'm like, there's things being thrown. This is ridiculous. What's going on? And I'm like, should I say something? And then I'm like, I found out like 6 months later, this is like the number one guy who's like putting up a P&L for a couple of years, like really high up guy. And I'm like, I think I didn't say anything. It was like, so, but I think it's probably calmed down, over the years. I think it kind of gets, a little bit more mellow and professional, a little less locker roomy, but I'm not on those floors anymore. And yeah, those are more the one-offs, I would say. They're entertaining enough. Because there's a lot of emotion, right? There's high stakes, people are emotional, and I've seen it both ways. People are yelling to get out of the system, and they're yelling sometimes at people, or so.
And fascinating. Yeah. After those years' work, go on.
The thing is always, this job's hard enough. You don't need to work for an explicative.
Yeah, yeah. Oh, for sure. For sure. You worked at Millennium, at Citadel, analyst at Citadel, and then portfolio manager at Millennium. What are you doing now? Why didn't you take that job at Citadel? You mentioned there, like, they offered you a job. I think there are many people who, you get to run a book at Citadel, like 100%, sign me up. Why'd you say no? What do you do now?
So what I do now, I do a bunch of different things. I have a podcast, Pitch the PM. I have my own little Westport Alpha group where we do a bunch of, smaller deals, more family office style stuff, SPVs. And, I also have 3 kids, so that takes up a lot of my time. When you're working with people, you're a weekend parent at best. You're working Sundays. You're doing, your mind, even if you're home, your mind's always there. So it's a little bit more balance, change of values. When I was climbing the ladder, everything was, I'm climbing this, I'm doing everything, you have tunnel vision, right? You make a lot of trade-offs and sacrifices, and, prioritize your work, and you're climbing the ladder and not your relationship. So, you can only do that for so long. And why didn't I go back? Well, there was a couple iterations. I'll leave it at that. There was a yes, and then there was a change, then there was a no, but I don't think I'm going to get into all the details. I think I had done that, right? And it's kind of like, what's next? I kind of accomplished that role, and I wanted to. I also didn't live in the city. I was now in the suburbs, and I wanted to see what else was out there, grow in a different way. It doesn't grow my bank account the same way, but there are some other objectives as well, to grow professionally, and we'll see where this goes. I have the podcast. I'm having a lot of fun. It feels fulfilling to help people out. I'm still talking about stocks. I do my own investing. And there's a bunch of opportunities that are coming across my desk just from putting this out there. And so there's one opportunity right now for multi-strat where they're asking me to come in as a CIO to kind of run a bunch of PMs, but similar, it's not too different when I was doing Millennium, where I had a bunch of sub PMs. So we'll see where that goes. This is it's early stages in that conversation. And I enjoy giving back. I recently had a post about a friend who just left Millennium. He was at BAM and then Millennium, and he just gave back a very large book and to go be a teacher. And he was over for dinner the other day, and he's like, I feel fulfilled. And he had done well, and he wanted to do something else he'd done for 20 years. And is in a fortunate position to be able to make that decision. So whatever I said no to Citadel in the beginning, no. I mean, I was, when I first met with them, I remember I went in for one meeting. It was probably like the 3rd or 4th interview, and I probably had the flu, or I was really sick. I was like sneezing, coughing. They're like, "Why'd you come in?" I'm like, "Well, I just wanted to show you that I really wanted this job." And they're like, I clearly shouldn't have been at work. I was, they're like, "Oh, I'm not gonna shake your hand. Like, you shouldn't be here." Well, yeah, when I was earlier, that was the seat I wanted. That's why I moved from DC to New York, and that, I wanted to be Citadel at the time. There was a Citadel at 0.72, but they were going through a little bit of a rebranding. So the smartest guys were at, Global Equities or Surveyor, and that's where I wanted to be. That was my job, and I I jumped through hoops, and I showed them I was 100% committed. I'd do anything to be here. This is the seat I wanted. And they saw that commitment. They probably didn't appreciate the exposure to the journal. But I'm still friends with both of those BD folks. So it's just a different point in my life. And yeah.
No, I admire you taking a step back from highly prestigious, extremely high paying role to focus on your family. I think that's admirable. And I think that does lead to fulfillment down the road for sure. And even now, I'm sure. I guess my question is going to be about advice for young people. So when I started the podcast, and you also have a podcast, so I'll link it in the description. I used to have this set structure where it was about what the guests would do, and then I'd go somewhere towards advice. I'd ask the guests if they had kids, and then I'd ask them, how do you raise your kids to thrive in the world that's changing a lot? And I guess I want to ask that same question to you. I haven't done this in a while, but you have 3 kids. How old are your kids, Doug?
7, 5, and 1.5.
Wow. Okay, so you got young kids. So I am curious. I come from a large family, so I have 6 siblings. I'm the second eldest of 7, and so I've seen all my younger siblings grow up. I've seen my parents, teach them how to act and then discipline them. But what are some of the things that you stress at home to make them not just to raise them not just to be exceptional, I don't know, professionally and academically, but also just to be good people growing up?
Well, I'm trying to teach them to be kind to each other. And I'm trying to show them that they're loved. At this point, at this age, I'm not really focused on them to create a profession or excel at anything. I want them to be happy, and I want them to find activities that they love, and those are my focuses. So it's a little different than, I guess, when they get older, then you can maybe worry about what school they're going to or what their career path is. That's not right on our plate right now. Now it's just trying to teach them to be kind people to each other with siblings, or that's kind of it, and let them know that that we love them and support their interests, whether that's reading books or playing guitar or just learning a few words. I went and had thank you the other day, and that was an amazing experience.
Yeah.
So just trying to be present for them and their activities. That's kind of my goal. It's a lot.
Wonderful. I think that's a great place to leave our conversation. Thanks a lot, Doug. Really learned a lot from this. All the best with everything.
Sure. Well, thanks for having me. And anyone, feel free to reach out. We've pitched the PM. We're on a bunch of channels, and you DM me on LinkedIn. I typically respond.
Amazing.